The Nasdaq is slowly approaching correction territory, and just as the bull market came, it appears to be leaving. With big tech earnings unable to push this market higher, market breadth looking grim, and Bitcoin rallying, is everything falling apart. The S&P 500 just made a lower low, and it's coming dangerously close to my line in the sand, a crucial level that has held the market together for the past 24 months. And we need to talk about what happens if this level breaks and what comes next. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. Brutal selling pretty much across the market. Big tech copped it the worst. Look at this. Amazon down 5%, Google down 9% on great earning. Microsoft held tech together. We saw quite a rotation into staples, and we also saw a bit of buying in utilities. So it was a defensive rotation day today. Other than that, it was pretty brutal, particularly in technology. You know, like I mentioned, staples, utilities outperformed, but it was a red day in the market as a whole, with communication services on the back of Google down 5.89%. An entire sector down nearly 6%. But looking at commodities as well, we saw some safe haven buying, gold, silver. We saw crude marginally tick lower. So not much happening in the commodity space as a whole. But looking at yields, again, in the last month, we saw the low end of the curve increase significantly, as well as the short end of the curve stay relatively flat. But if we actually look at what yields did on the day, yields went up, 10-year went up, 30-year went up. The 2-year stayed relatively flat, as well as the 3-month. There wasn't much action in those, but big story was the 10-year, and that's why we saw a lot of risk off in the equity markets. You know, yields were up, stocks were down, rotation into defensives. Now looking at earnings, guys, we have one more big name for the week, Amazon, as well as Exxon and Chevron. I think Amazon is going to give us a really good indicator to what the consumer is looking like. So far, Meta produced pretty good earnings. I thought Google's earnings were great. I really did think Google earnings were great. They missed on cloud revenue, and so instead of growing by 25% year over year, they grew by 24%. And the stock's being sold, 11% in the last 2 days. I don't know what Wall Street is looking for, but I thought Google's earnings was great. You miss earnings, guys, you're going to get sold 6%. If you miss your EPS, you miss your sales, or miss both, you're being sold downward of 6%. And literally, no one is safe, not even technology. Have a look at this. Google right here, guys, down 9% in the last 5 days, and in after hours, down 2.19%. And that's on the back of 25% year-on-year growth. I don't know what Wall Street is looking for. Look at Meta. You know, Meta beats on both the top line and bottom line revenue. They actually grew really well. They're one of the fastest growing mega cap names right now, and they're still priced about 21 PE, maybe even lower after today's 4% seller. But they did increase their guidance from 36.5 billion to 40 billion, and net income rose 164%. And we saw, look what happened with Meta here. We saw 4% down in the day and then 3% down after hours, okay? Although we did have this massive spike, because I do think Meta's earnings were good. But it did come down because the whole market sold. Big tech earnings is not helping this market. It's not holding this market together as we thought it would. The market is selling pretty brutally. It was a brutal sell-off today, guys. That being said, is tech a buy? The next 4 quarters, technology is actually going to experience growth. 4.8% growth for this quarter, and I think that's what we're seeing, maybe even a little bit higher. And then double-digit growth for the next 3 quarters up until Q2 2024. So I think tech is a buy. You need to look at the sell-off in the Qs, in the Magnificent 7, in the Mega Cap 50. Have money ready to put it in an ETF or put it into individual names. I do think this sell-off, especially with what Google reported, especially what Meta reported, they're really going to be seeing solid growth into the next year. Is the market as a whole cheap? S&P 500 forward PE is 17.3. I think anything below 17.5 is very cheap, and that's where you should buy. The historical average of the S&P 500 is 16.8, but 17.5 considering the amount of high quality companies you get in that top 10, top 20 category, even the top 50. The top 50 of the S&P 500 is incredible. You're really buying some high quality names right there, and paying a 17 forward PE for that is really good. If you are a long-term investor, again, I stress this, if you're long-term, 5 years, 10 years, 15 years, 20 years, you're going to be looking at this and saying, wow, stocks are of great value right now. But let's move on to market breadth, and this is the market breadth of the equal weight S&P 500, and we can see here that stocks above the 20, 50 moving average, only 10% of stocks are, and above the 200, only 21% of stocks are above the 200 moving average. But it's not all bad news. So this is the S&P 500, stocks above the 20-day moving average, and it's exactly the same for the 50-day. We can see here that we made a low, and then we actually made another low right here, a higher low, but the market actually made a lower low. What does that mean? Market breadth internals are positive, okay? It's a positive breadth divergence, and we can also see here with the MACD, I believe. Same thing. So even though the market is making a lower low based on the indices, individual stocks are actually making higher lows. Moving on, the McClellan oscillator, it sort of tracks something very similar. Stocks making higher highs versus lower highs, another divergence as the market indices move lower. Now, looking at some unusual options activity, and it was just large volumes all around, and especially in the big names, Nvidia, Microsoft, Meta, as well as the big indices QQQ, SPY, and IWM. What did Meta do? Let's have a look. So Meta actually had more calls than puts, as you can see right here. Now it did get sold off because this is just options volume and the market is more than just the options market. But all in all, it was a very large day for options volume. We can see right here that 42 million contracts traded and 51% puts to 49% calls. Very, very big day. Let's get into seasonality, okay? So we do know that market breadth internals are on the up and up. They're starting to improve slightly, even though they have been in the gutter the last 2 to 3 months. Now, this right here is the October market performance in 2023 versus the 21-year period, 2000 and then pre-election years. So the solid line is just a normal year. Dotted lines are pre-election years, okay? And I believe the circular line, so these dots right here, is 2023, where we are right now. So normal, pre-election, where we are right now. When we actually look at it, we are still exactly as seasonality dictates in pre-election years. So we did make a lower low right here. We are going a lot lower than the typical seasonal adjusted period for pre-election years from 1950 to 2019. However, you have to understand that rates have been increasing significantly. And despite the rate situation, despite the economy situation, despite all of the factors outside of the market that do affect the market, we are still following seasonality. Let's dig a bit deeper, guys. So this right here is S&P 500 pre-election year and aggregate cycles. This is broken down even further right here. So they're the exact same chart, just spaced out so you can see. This is what happens. So you can see here, the NASDAQ normally has its best 8 months, and this is what we are doing right now. This is 2023. So we've had an absolute run up, then we've had a come down, made a low, gone up, made a lower low, made a lower high, then made a lower low again. If we actually look at the pre-election year seasonality, this blue line, we do exactly the same thing. We make a high, make a low, okay? Then we make a lower high, another low, a lower high again, a lower low, and then we rally, okay? It's exactly here. So rally, rally. We are following seasonality to a T in October and for the year. We need to play the game, and I have been buying. I bought a lot of NASDAQ here, I bought a lot of S&P 500, and I bought a lot of a ticker called MOAT, M-O-A-T. Again, guys, digging into seasonality, digging into NASDAQ seasonality, okay? We are following seasonality, and if you look right here, from the October low up until the November to December high, or the year end, we normally return anywhere from 9.5% to 13.1%, and at a clip of 88 to 98% of the time. So, am I a buyer? All things considered, based on seasonality, based on market breadth internals, based on my line in the sand, I am. I put this on Twitter, guys, and I said the Q4 rallies to commence in the SPX if we manage to stay above the 4150 to the 4125 area. We are around this area right now. We're at the 4150 area. If by November 11th we are below, I'm going to reassess everything and I'll keep you guys updated. Until we break that line in the sand and we don't fix it or repair the technical damage by November the 2nd, I'm 100% a buyer of dips. And this is a dip. I'm buying Google, I'm buying Meta, I'm buying NASDAQ, and I'm buying the ETF, the NASDAQ 100, and I'm buying an ETF called MOAT. Those are everything. So I am a buyer in this market right now. Let's actually have a look at some dark pools, guys. So we were looking at this in previous videos and we saw some buys coming here. We were speculating that it probably was sells, but we weren't too sure. And we can definitely see that they opted to short the bull ETF. So I guess institutions do that because we did see movement lower. I also want to point out the Qs right here. We saw quite a number of large trades, as you can see here and here, well over a couple million. It's yet to be seen what happens. I don't think these trades are significant enough because we do know that they are short much higher. So maybe they haven't fully closed their trades. Maybe they're looking at buys right now, but all we can say from this is that there is significant amounts of volume coming in here, both buys and sells. Looking at the S&P 500, very similar situation, around the same time, around the same area, big buys coming in. Again, a couple million shares. There's still a lot of open interest, a lot higher, which means a lot of these institutions are short. So if we do go lower into the rest of the week, I do expect that to happen. I think we're probably gonna move, a couple of percentage points lower. but we did see huge capitulation yesterday. So guys, have your bag ready, be fearful, be greedy when others are fearful, have your money ready and get ready to put your money into stuff like technology, great balance sheets, okay? Or if you don't want the risk, look at ETFs, look at bull ETFs, look at NASDAQ 100 ETFs, look at the S&P 500, even look at the Russell. Just have your money ready because we need to be greedy in times like this. When the market sells off, I get excited, I don't get scared. Recessions are very short-lived. We've been here before, stocks have rallied. We've been in this situation before, the economy has always come out better on the other side. Sure, there's going to be a bit of struggle. Sure, we're in unprecedented times. At the end of the day, I remain very bullish on the American economy and the Australian economy long term. Thank you so much for watching, guys. Please like, comment, share, subscribe. I really do appreciate you guys leaving your comments, ideas. Follow me on Twitter too. I'd like that too. Catch you later.